CNBC presents Power Lunch with Bill Griffith and Michelle Caruso-Cabrera.
Fixed annuity. It is a tax-deferred investment vehicle, generally guarantees that you will earn a set rate of interest over a certain period of time, and you won't pay taxes during that period of time. The interest rate, it's offered based on market conditions, and it can change periodically. Here to tell us what to look for before investing in fixed annuities is Mark Brown, certified financial planner and partner at Brown and Tedstrom. Thanks for coming in.
Thank you.
A lot of people are attracted to these right now because they guarantee a rate of 4 to 6%, and the market's pretty weak. But do you really want to lock in for that length of time?
Yeah, there's been a huge rush to these fixed type of products with the poor stock market, and we keep on advertising 40-year lows and interest rates. I generally don't think that's a great time to be putting money out to lend or locking in it right now.
All right, let's say you are considering an annuity. What should you really be looking for? What are some red flags about maybe why you shouldn't, or things you should look for about why you should?
Well, at first you want to look at the rating of the insurance company.
That's backing it.
Yeah, I mean that's all you really have is the rating of the company. So if you have a high rate, maybe 6 or 7%, you might want to look behind it and see why it's that high. It may not be that great of a company.
It may be a higher risk, and hence why they have to pay you more to give them your money.
Right, and they may be taking higher risks with what they're investing in.
You also have to look at whether or not there are high surrender charges. What does that mean?
Well, usually what happens is that the rates in which they guarantee, those surrender charges will kick in the first year and usually decline over time. But they're so high in the first couple of years that it really locks you in. You can't move it to another place very quickly without really getting hurt.
Okay, let's take some phone calls. James in California, go ahead. What's your question?
Yes, I'm 78 years old, and I'm thinking of buying a fixed annuity. I'm in very good health, and I was wondering what the effect of, let's say, future inflation and interest rates and/or deflation would have on the value of that fixed monthly check.
Good question. Do you have to ask it about any kind of interest bearing?
He's talking about a fixed monthly check, which sounds more like an immediate annuity versus a fixed annuity, but it's the same sort of idea. It is not an inflation protection vehicle. It's going to stay flat, and the rates are not going to be much above inflation as they are right now. So, as any fixed vehicle, it's not an inflation protector.
Okay. Tom in Connecticut, go ahead. What's your question?
Yes, my question is, I have an annuity with a company, and I'd rather be with another company. If I roll over, I pay a surrender penalty, and if I withdraw it, I pay a tax penalty. Is there a way of annuitizing from the first company to the second company and avoid the taxes and avoid the surrender penalty?
No, there really isn't. And that's the downside of these fixed annuities, that once you've locked in with this one company, you're with them. So diversify companies if you're going to buy them.
Okay. Marty in Massachusetts, go ahead. What's your question?
Hi. Some of the annuities seem to build in inflation protection. For example, with TIAA, that's the case. You can get one with, they'll hold back some money. I was wondering, is there any of these annuities that would protect against really high inflation, or does it just protect against expectable inflation?
Generally, if interest rates are higher, so is inflation. So you're going to benchmark very closely to, say, the 5 or 10-year bond market, and that's not an inflation protector. So fixed annuities are there for safety and predictability, but they're like a bond, but they're not there for growth, or to protect against inflation.
And there are some who argue that they're even more expensive than, say, just buying a bond because of some of the costs associated.
Higher costs, and the only upside to that is you don't have the variability of price that you do in bonds.
Okay. Thank you very much for coming in.
Thank you.